Market imbalance is basically the moment when one side pushes harder than the other, and not every imbalance leads to strength. Some are nothing more than noise pretending to be momentum. In this video, I break down the different types of imbalances, how they form, the logic behind them, and which one can be much stronger. Next, I will move on how to look at imbalance using market profile and footprint charts. These tools allow you to see the structure of the market from a different angle and collect a clear picture of where the pressure appears and why the prices shifts. Let's get started. First of all, let's start with one of the most popular ICT concept, fair volume gap. This is the most common type of market imbalance that traders recognize. Fair volume gap is a space between candles on a price chart created when price moves very quickly. In other words, the price moved so fast that it didn't trade at some prices in between. This leaves a little space between candles. That gap is untested, nobody traded there, and the market often swings back into that area to fill it before continuing. Why price goes back to fill imbalance? Markets always try to balance supply and demand. When the price moves very quickly up or down, it creates an imbalance because some price levels were skipped and no trades happen there. Later, the market often comes back to those levels to complete the trading activity that didn't happen before. Nobody wants to buy the price that suddenly becomes too expensive, and nobody wants to sell the price that suddenly becomes too cheap. When the market is in balance, it becomes difficult to find new large buyers or sellers because the price is no longer attractive. Therefore, the market needs to return to balance so it can attract new participants and continue move normally. The market often comes back to this imbalance zone to rebalance price and find fair value again. So pay special attention to fair volume gaps that appears in discount area. And these zones often provide high probability trading opportunities. Okay, now let's watch at forms of imbalances. First is BISI. It means buy side imbalance and sell side inefficiency. Buy side imbalance tells us towards which side the fair volume gap is created, and sell side inefficiency tells us sellers didn't get a fair change to get involved. To make it clear, let's take a look at a real chart example to see how it works in practice. In this case, the imbalance forms within a balanced price area. It's filled almost immediately, so no empty space remains. After that, we can observe a small imbalance, and as volatility increases over time, the market begins to move in a more imbalanced state, leaving behind a larger fair volume gap. If we compare this situation with the early phase of the market, we can see that the price was moving mostly in balance, meaning there were no significant empty areas left behind. However, in this later section, the market breaks out of balance and starts moving inefficiently, creating clear imbalance and larger fair volume gaps as it progresses. And after a while, the market comes to these imbalance zones to balance the market and then go further. And in conclusion, what does a BISI tell you? Price moved upward too fast. Sellers didn't have an opportunity. The fair volume gap can be traded back into that balanced market. This would allow sellers a change to get involved. Now let's take a look at SIBI. SIBI means sell side imbalance and buy side inefficiency. Sell side imbalance tells us toward which side the fair volume gap is created, and buy side inefficiency tells us buyers didn't get a fair chance to get involved. Let's take a look at how this plays out on the chart. We see a strong impulsive move, during which a fair volume gap forms. This fair volume gap represents imbalance. After an imbalance is created, price often returns to the fair volume gap at some point. Of course, it doesn't always revisit every single one, but it frequently moves back to certain areas in order to restore equilibrium in the market. In this example, we can clearly observe how price comes back to fill the imbalance, balances the market structure, and reverse it afterwards. In conclusion, what does SIBI tell you? Price moved downward too fast. Buyers didn't have an opportunity. The fair volume gap can be traded back into that to balance the market, and this would allow buyers a chance to get involved. The next type of fair volume gap is inverted fair volume gap. An inverted fair volume gap is when a normal fair volume gap forms and later an opposite direction fair volume gap appears and completely covers or overlaps it. In simple terms, it's a gap that gets closed by another gap moving the other way. Let's break down this example. We had an impulsive move to the downside that completely filled the previous bullish fair volume gap, which resulted in the formation of an inverted fair volume gap. From this zone, a reaction could reasonably be expected. After some time, price returned to the inverted fair volume gap and continued its downward move, while at the same time balancing the bearish fair volume gap in this area. The next type is volume imbalance. A volume imbalance is created when price moves so quickly in one direction that it leaves a small gap between candles. This happens because the one side of the market, buyers or sellers, is much stronger and the opposite side doesn't trade back. The market skips a few prices, leaving a teeny empty space. Later, price can return to this gap to rebalance the move and fill the area that was skipped. In this example, we see two candles form with a small gap. This gap is called a volume imbalance because the market didn't fully trade that area. After some time, the price comes back to this zone, fill the imbalance, and then reverse it in the opposite direction. To be honest, I don't focus on such type of imbalances, and in general, such a gap basically occurs at the same time with originally a volume gap. And the last type is gap. A gap is a larger empty space between two candles. It appears when the price opens much higher or lower than the previous close, leaving an area with no trading. Basically, this gap usually forms because of stronger news. Gaps often attract price later because the market tends to return and fill the area that was skipped in order to rebalance the move. However, in some cases, especially after major news, that gap can remain open if a new price level is accepted by the market. Let's break down this example. We see a strong gap with a significant price jump. On Friday, the very important SIBI news releases, which caused this gap to appear. After that, the price continued moving upward instead of filling the gap immediately. After some time, the market reversed and moved back toward the gap. As you can see, at first there was a small reaction, but eventually the price broke through the gap. Later, it retested this level again. The price was held at this area and failed to move higher. From this example, we can notice that the gap level acted as a from rising and serving as a key support and resistance zone several times. Now let me explain about true open fair volume gap. I pay special attention to this gap. True open fair volume gap is the first fair volume gap that forms after true open, such as a true day open, true monthly open, or true session open. This first gap is considered more powerful than regular gaps because it created directly from the initial order flow of the session or time period. This fair volume gap can act as a strong support and resistance, and often sets the tone of the rest of the session or trading day. In this example, let's pay attention to the first fair volume gap after the true weekly open. We mark this first gap and use it as a reference throughout the entire week. We can see that right after the open, price created an inverted gap. For a while, price stayed above it, and we can observe how the gap acted as a temporary barrier. After that, price broke through it and moved lower. Following a bearish move, price eventually reversed to the upside. As we can see, it broke through the fair volume gap again, briefly held around it, and then continued higher. Later, price returned to this gap once more, showing another reaction. Overall, first fair volume gap after true weekly open, true daily open, or true session open can serve as a strong support and resistance zone. This fair volume gap behaves similarly to BISI and SIBI, but here we focus specifically on the first gap that forms after the true open. So if you want to know about more detail, you can watch my video on YouTube. Okay, right now let's watch an imbalance from another point of view. For this, we will use market profile, or it's also called time price opportunity. You can see certain information in the market profile which is called single print. A single print is a single block on the TPO that shows a market imbalance. Single print helps traders see where buying or selling was imminent and where price moved too quickly in one direction. They are often marked automatically on the chart. First of all, on TradingView using TPO indicator requires a premium subscription, which not everyone wants to pay for. That's why I personally use gocharting.com, where you can access a market profile for free without a paid subscription. I will leave a link to the site in the description. So, how to add market profile on the chart? At the top there is an indicator tab called Study. We click on it and write market profile in the search bar and click. After that, we have a market profile on the chart. First of all, let's set it up so there is no confusion and it's much easier to use. You can click on the market profile twice to open the settings, or on the left upper corner you can click the gear. The first one is color. You can adjust the color at your discretion. Then, if the letters in TPO squares interfere with you can hide them by clicking on the hide letters. Then there is the market profile value area. You can leave these lines, but basically I remove them so they don't confuse me because value area is painted gray background. Further, if we go down below, we can see a single print tab. We must turn it on to see the imbalance on the chart. We also adjust the transparency. Now let's analyze example of how to use a single print. Let's analyze this example. At the top, we have a single print of the previous day, and it can serve as a magnet for the price, from which we can also expect a reversal. But we always need to look at the reaction because there may be a breakout too. Because real traders, he is not predict, he is react, okay? And a few times later, price came to this zone, and when it's in the imbalance zone, we need to look at the reaction. You can use different entry models. Personally, I look at the SMT divergence and market structure shift. So this is Germany 40, and the correlated asset for it will be France 40 or Euro 50. And if we look at France 40, we can notice SMT divergence. After that, we wait for the market structure shift, and after the break, we can open an order to the nearest trigger. Now I need to make an important note. In TPO, you can notice a single block at swing high or low of TPO. This is not a single print. It's called buying or selling tails, but it doesn't mean imbalance. In the market, it has another function. Maybe I will make a video about it and explain how to use it in more detail, because it's really powerful thing that can improve your trading. And before I will show you the last type of imbalance, let's talk about the difference between a fair volume gap and a single print, and why I prefer to look for market imbalance using market profile rather than a standard ICT or SMC concept. When we analyze a directional move, for example, a strong move down, we can clearly see fair volume gaps along the way. These gaps shows where price left quickly with a little or no trading. The problem is when you only rely on the chart itself, you don't really know which of these gaps the market is actually going to revisit. Now let's turn on the market profile. Market profile allows us to see the structure behind the move. It reveals which gaps are meaningful and which one is just noise. With market profile, a single print gives us a much clearer signal. When a fair volume gap forms inside the value area, that's an area where a lot of trading has already taken place. The market was balanced there. For me, a gap inside the value area doesn't automatically mean imbalance. It simply means price accelerated, but still in a zone where buyers and sellers were active. But when a single print forms outside the value area, that's where we see a real imbalance. This is where participants were forced out, and that is the gap with the highest probability to be filled later. Of course, sometimes price doesn't reach the gap precisely. Sometimes it reverses early or even breaks slightly through it and only then reacts. But overall, single print highlights the exact imbalance better than a plain fair volume gap. That's why I focus more on market profile. And now let's move on the last type from the footprint chart. In footprints, there is a term stacked imbalance. A stacked imbalance is formed when aggressive buy or sell volume on the side exceeds the opposite side by 300% or more. And this imbalance appears on several price levels in a row. To detect an imbalance, we don't compare volume horizontally, line by line. We compare it diagonally, crosswise. And if one side shows 300% domination, that price level is an imbalance. So to be honest, I don't have access to footprint chart right now, but I can show it on the screenshot. Let's look at this example. In the first case, we can see a bullish stacked imbalance, showing strong buying pressure. After some time, the market begins to rebalance, and this creates a bearish stacked imbalance, indicating aggressive selling from the opposite side. Once the market finishes rebalancing the bullish stacked imbalance, price shifts and starts balancing the area formed by the bearish stacked imbalance. After this rebalancing process, the market reverses and continues move downward to balance the other imbalances below. In general, it's best to use platforms that provide the real exchange volume, such as Atas, Sierra Chart, NinjaTrader, Quant Tower, or Bookmap. These platforms use actual market data. When it comes to TradingQ, the volume show there is not real exchange volume. It's tick volume, which counts only how many times the price changes. Because of that, it's not as precise as a true order flow platform. It may not reflect real buying or selling aggression. So guys, this is the end of the video. Thank you for watching. See you in the next video.